Good turnaround Tuesday, Warriors. How you doing, RC, Blake, AJ? Trusted up. Welcome to Face. Hi, Sinatra, Glenn, James, Paul, Mike. How you doing, Ryan, Kman, Hugo, the whole crew? How's everyone doing?
Morning, Dale.
How are you? How you doing,
Good, mate.
Ryan? So we may as well start off with the RBA was last night.
Yep, it sure was.
So what we talked about yesterday manifested that they would blow the Aussie rally that was being attempted. What they do and what they say.
Well, yeah, they definitely put a pin in the rally, although it was a small one. There was another small step away from hawkish to more dovish. They said they saw some. Oh, excuse me. Let me just shut that up. Sorry. They said they had gained some confidence that inflation was coming down to target over their forecast period. Wages have been lower. The economy has been softer. Not ruling out any hikes or cuts yet, but they're stepping towards being more dovish.
Okay.
It's small steps for them. I still think they're going to be forced to chase inflation and the economy lower, i.e., faster cuts. But we can kicked into next year now.
Okay. So we'll see. I'm thinking maybe I don't know, 100 lower or so. See what happens. Yeah,
That'll be
are
nice.
these? Huh?
That'll be nice.
Are you short?
I'm sure Aussie Kiwi have been since the beginning of October waiting for this
Okay.
turn. So yeah, we need to take out those lows. That's been the significant thing this morning on Aussie versus US dollar and Aussie Kiwi. We had
Yeah.
those prior lows and we
Yeah.
couldn't take them out this morning, which might mean we're going to find a bit of a base for the short term.
Okay. Thanks, buddy. Anything else important that you shared on your show earlier? That
Uh, Yeah, well, in the chat room, we've got a bit of a break going on in euro sterling. Finally, under that
yeah,
82.76 level,
that's right.
so that could
There it
could
is.
could mean we're on our way to the low 82s if it can hold under that 60 70 area now.
Okay. And Euro, think we can make another trip down here, Ryan?
Yeah, we can do. I
Mm,
think it's going to take something significant to do it, be it year-end flows or something really hot in the data tomorrow in CPI. But
yeah.
yeah,
Okay.
otherwise I think we're 104.50, 106.11. That's your range.
Okay. Thanks, buddy. Nice insight. Good morning, K-Man.
Heidi, hi, Mr. Dale.
Well, we're almost at one of the big round numbers, 52. Think it has
Yeah,
enough juice to do another 100 pips
well,
towards this moving average.
yeah, the thing, I think it should, well, if it has to cap, it has to cap between 2 and 2.25, in my opinion. But if it goes above 260, I have a bit of a trend line. It goes above there, then I trust some are going to run there. Ryan updated a bit of a potential M&A going through. Also, Japanese mega banks wanting to put some of their money to work. That is always going to be the issue with when you trade the yen, is that for as long as the Japanese whales and the big insurance companies don't find the levels in the JGB where they really want to pile in and repatriate yen in order to do so, you're always at risk that in the shorter term or even in longer term, this time the M&A, they want to put their money to work outside to look for growth outside of Japan. So that's always a bit of the risk that we have. But if you look at it technically and looking at the breaks that we have, we should find resistance between anywhere between 150, 190 and 152 quarter, 152.30 ish. But as again, as I said, if it goes through 260, I think some of them are going to run.
Okay, through 260. Okay.
Yeah,
I got
that's
something.
where I have a trend line, a bit of a trend line coming in. Mm.
Okay. Yeah, and there's moving average. Look, this moving average
There as well,
52.14.
yeah.
And then on the 4 hour, you had, I think
Mm.
yeah, same thing. 52.76 will right up in the zone.
And,
Okay.
and and what we need to note as well is that we held the sort of no, we held because we never had a close inside the daily cloud in the last run lower. We went inside, but then I don't think we got a close really inside the cloud. So that comes in now just around 150 and 150, 150 and a quarter or so. But it was at one stage in the 149s, and we tried below, but we never closed
Yeah.
inside. So that's still important for the Japanese as well.
Yeah. Hey, you get off of my cloud.
Exactly.
Huh? Don't hang around. All
And
right.
the other one is
Anyway.
get out of my dreams, get into my cloud.
Oh yeah. All right. So Looney, we did get the third drive up here. It's diverging a little bit. I think these are the ones you pay attention to in the next week or two. It's long
Mm.
in Aussie and maybe a short in Canada.
Aussie's
Anyway,
holding that trend line since
yeah,
what is it, 2022? It's holding the trend line just, but it's holding right now. The Aussie
yeah,
comes in
yeah,
around 63, give and take three quarters, give and take the usual algo pips or so. Comes in just around the lows we've seen today.
okay. And we're having a little pop in yields. They're still, you know, pretty tightly correlated. Yen turned before
Yeah.
yields did, but
Mm.
I don't know, maybe back to 430 first.
Well, it could
I
be.
don't
I
know.
think we are still in that zone. People talk about the 420, but 420 to me is more a hinge than a big level. I think we are sort of around, and I've been saying it for a while that when we came back to 420, I said this is kind of where I think the equilibrium zone is right now.
Yeah,
So yeah, from here you watch the CPI tomorrow, and then I think we can start year end. CPI will probably decide on what the FOMC wants to do next week, hold or do a quarter or so. But I still think they go a quarter. So yeah,
yeah.
I think the yields are going to tell us if those guys need to do stuff for year end.
Okay, silver, it's gotten through some
Holding
moving
well.
average. Yeah. Uh, Down here, I thought we'd go to 32 and a half or so.
Mm.
Still not there.
Yeah, if
Uh,
you look at this the right where we stopped there at 32 and a quarter, 32.30
yeah.
is halfway of the correction that we saw, the big correction from 35 back down to 29 and a half. It's
Okay.
halfway is around where we topped yesterday.
Okay. That's interesting.
Hmm.
So, it's we're getting to some important levels because if it starts expanding from here,
Yeah, yeah.
it's more than just a bounce.
Hmm.
But right now it still could be just a bounce. Gold acting better. What are you
There as
thinking
well,
there?
we are in a zone, a bit of a trend line there, on the from late October over the high in November. We are a bit of a trend line there, 26.7580. That's where we stop right now. But yeah, it's for the
Yeah,
thing is it's not making fresh highs, but if you want to buy it, you're disappointed, right? Because you don't get it below 26.
yeah. Okay. Um, I guess the only thing we really haven't attacked is risk. So we had a little reversal day yesterday. Like, uh, probably doesn't mean anything.
But yeah, I mean, we're still above that 60-30 breakout point from, 2 weeks ago. So, it's hard to get bearish. Yeah, I mean, I guess you got three, two, three. So are we on the fifth drive now?
We're on the 1 millionth. But on the weekly, this is a 3. But I remember when we first made this high for a 3, that sometimes on the third drive you get a fractal, like where you get you get 3 within it. So I don't know.
And you do halves.
Maybe this was 3, but this is one of it, 2, 3. But yeah, this is I mean, if you look at it and you want to find one reason to be a bear technically, which hasn't worked, is with all of this strength, we still haven't blown out the divergence at 70. And
Yeah,
the same thing with NASDAQ, but doesn't mean it's going to go down. Just means that it's not confirming.
right.
So
And
it could do that a while.
there's the other thing that's happening right now that you're talking about risk appetite, and I'll grab the charts right now.
Okay,
One of the
there you
things
go.
is that we've seen a stall in Bitcoin. So
Yeah.
and these cryptos have really stalled. I'll come back to the CAD because I think your assessment is right there, or at least I agree with it near term. But let's go take a look at crypto, and you take a look at some of these names. Well, first of all, on the week ahead video, discussed that the Bitcoin, you got to play on both sides of 100,000 now. I mean, and yesterday you can see some of these moves that are pretty aggressive. Not only in Bitcoin. Look at like what happened in Ethereum. I mean, that's a scary ass move right there. Cardano, these are big moves percentage wise, and but it's not, the market's not cratering. It's just, you're seeing two-way price action and, a bullish consolidation. And so buying, cryptos down here makes sense. But, you transfer that, like that risk appetite to the S&P. A lot of people were getting bearish yesterday and saying that, this is the top, this is it. And, and I see the, the bearish candle there, but we're still, finding buyers ahead of the breakout point. Then you look at the DAX, like for example, the DAX is almost at all-time highs this morning. I mean, it just, the reversal here is just whoop, right back up again. These
Well,
all just look,
Germany's booming, man.
but we have to remember, the stock market is not the economy. That's the same thing for Germany too.
Right.
And it's the same for the US.
What is it? A Ponzi scheme?
It's just a Ponzi scheme. Yeah, it's where,
All right.
where money's just being put right now. I mean, and
Yeah.
it's everybody's chasing the market, and it's the game of hot potato, or musical chairs, whatever you want to call it. But
Yeah.
right now, I mean, it's hard to fight. It's hard to fight the markets while they're so well bid, and going into, well, we're knee deep into the seasonal aspect of the market where people want to be long. They want to be long for Santa Claus. They want to be long for window dressing. They want to be long for putting money to work, or I'm going to get redemptions, whatever you want to, however you want to spin why the market's up. I think we're going to have a lot of great shorting opportunities at the beginning of the year, Dale. I do. I think there's going to be some really, really wonderful setups to be on the short side of the market, but it's hard for me to commit to that idea right now, knowing that, we have inflation tomorrow, as you guys have been talking about, and if CPI comes in, in line with expectations, or maybe even slightly below expectations, that's just another tailwind for the Fed, to cut by 25, leave the door open for potentially more cuts into next year. And as Kman was pointing out with yields, yields will fall, dollar will strengthen, or a dollar will fall, and equities will just, hold their bid. I think that's the risk going in the next couple of weeks, but we'll have to see, following the inflation data tomorrow. And therefore, with all
Can I
that,
ask a question quickly before
yeah,
you move on?
sure thing.
If you think about selling stocks in 2025, what happens if you get a 5, 6, I don't know, 7% correction in year-end flows with people closing up the books? Do you buy that dip, or do you sell it more into 2025?
No, I think you do. I think you buy that dip in anticipation of the Trump administration coming in. So, like, using your idea, Ryan, let's say we do see a 6% correction into channel support here in the S&P. And let's say we get, profit taking, maybe, I don't know, just locking in profits, however you want to spin it. I think that's the level that you want to be really long, equities going into the beginning of the year. Then, probably sell on the Trump administration coming in. What do you think that we're gonna see equity market selling into year end?
Oh, I don't know. Well, it's one of those things where you can have a plan for something, and then something else happens, and then it disrupts your plan.
Oh, that happens to me all the time. I mean, I always plan what I think is going to happen, and then it doesn't always come out that way, and sometimes, and a lot of times, it actually works exact opposite of the way I'm planning. But just understanding where we're at in the markets, I mean, I think the biggest issue, and I know I've talked a lot about this, is this market is up so much on the year. I know there's going to be pension fund rebalancing. I get that. I get those ideas. But how many if you listen to YouTube and you read newsletters and you read a lot of banks and a lot of analysts, how many people have just said we're on the cusp of recession all of this year? All of this year. I mean, and if you look at the markets and what we've done and so the reason why I point that out is how many people have been playing defense all year, listening to their guru macro analysts that they pay, X amount of, hundreds of thousands of dollars to these, these economists that write specific research for them. And they've missed, the S&P being up 30% this year. I got to imagine that they're sitting here at year end going, damn, I have to really put some money to work, especially if CPI comes in weak tomorrow. Especially if the Fed is going to continue to ease, and I've got just a couple of weeks to put money to work. But you're right, Ryan, we could definitely see some profit taking here too. I mean, we are up on 30% on the year. That's a hell of a year. When's the last time we've seen 30% up on a year in equities? Except for, maybe post GFC in 2009, 2010, or, and I'd have to go back and take a look, or, post, .com crash, post September 11th, sometime in maybe 2003, 2004. I'd have to go back and see, but this is a massive year for equities, any which way you slice it. So
2020, I think must be close.
Oh yeah, I guess post COVID. Yeah, I mean, 2020. Let's see. I mean, well, I mean, this is you'd have to go 21 maybe.
Yeah.
So 21 January 21 to December. I guess we were almost up 30%. And look, we pushed another 5-10% before the market really did a correction. So, I mean, you're talking, I guess that is something similar. I mean, these markets look unhinged, and like I said, it's hard to stand in the way right now, just knowing where we're at. But I think there's going to be a lot of opportunities. I mean, if you're bullish, we could see, in the right environment with, like I said, with an easy Fed and a kind of a benign or inline print with CPI, we could really see equities kind of, roll higher into year end. I think that's entirely possible. And then it'll give anybody who wants to be on the short side, I'm waving my hand right now, anybody who wants to be on the short side, I think, early next year, the opportunities for being short up here around the 62, 6,300 level, I think are quite great. And I think it's, a pretty decent probability at this point. But, we'll have to see. I think there's a lot that happens between here and there. One of the things I wanted to mention, since tomorrow is CPI, today is, I think, a range day. And yeah, you got Euro trading on its lows here. As Ryan, you pointed out, 104.50 to 106.30. That's our range in the euro. I think this is the one where you gotta be looking to play. I think sterling is holding up pretty well too. I mean, you look at how sterling is acting against the euro. That should keep a relatively decent bid in sterling. What ranges are you looking to play, Ryan?
Which one?
Well,
Cable?
Ryan's here or no? I'm just asking. No, which ranges would you be looking to play in the FX market today? What do you think?
Today, yeah, definitely got to look at euro dollar. If we get a test of 105, that's probably a decent level to look at. We know how big it is. If you're just looking for, maybe an intraday trade, you don't have to be too wrong. Cable, the pound is looking a bit resilient once again, but it struggled to get through 128 in cable. So, there's a topside level. And dollar CAD as well. That's another one. It bounced from 140.90-ish yesterday.
That was a hell of a bounce.
Hell of a bounce. Yeah.
Hell of a bounce. Still divergent.
And then went on to make a new high, which keeps the momentum going for that one. So, we've had a close test of 142. If we break that, I've got a level at 142.65. Otherwise, it's the big, huge double top on the weekly.
Way up here. Way up. Way up there.
Yeah.
Yeah, I mean the dollar CAD looks. I mean this thing. I don't know what's goosed it, but we do have the Bank of Canada. Is it tomorrow, Kman?
Yeah.
Or is it Thursday?
Yep.
Tomorrow. Is it tomorrow?
Yep.
Yeah.
Okay, tomorrow. All right. What do you guys think's causing this this Canadian weakness? I mean, I was thinking, okay, well maybe crude's finally playing into it, but I don't know. What are you guys thinking here?
Okay, do you want to know?
Yeah, this we were talking about it on the flow show. I think there's first of all a bit of expectations for the Bank of Canada because they could still do 50, although to me it's not my base case. But I also think that Trudeau was pretty pale in trying to get around the table. Oil's coming down. I think everything is weighing on the CAD right now. We could see a bit of a snapback tomorrow if the Bank of Canada only does 25 and Rogers manages to calm down McClem's dovishness. But the mood in the market, it seems, is for lower Canada and testifying that snapback yesterday, from corrections. So I'm thinking that it is possible that Canada finishes the year on a kind of weaker note, unless McClem changes tack and he says like, wait, we only do 25, and now we pause until Trump takes the seat.
Yeah, and I mean, thinking about what the RBA, the RBA just seems like they're going to be on pat or on hold for quite some time. They said they didn't even talk about cutting rates. They didn't talk about raising rates either.
Yeah.
And I think
Bullock is a hawk.
What's that?
Bullock is a hawk, so don't forget. It's always going to come over as they want to pause or whatever. But she has a lot to say over there because we don't hear a lot from other people at the RBA trying to counter any of her arguments. So for as long as she's hawkish, perhaps they stay hawkish. But
Yeah.
I think early next year, depending on the data, we're all data dependent, but I think RBA could surprise to cut earlier than what the market is pricing now.
One of the other pairs I wanted to just reference this morning is the dollar yen, and I don't have any yen exposure as you guys know. Yesterday I closed out my Canadian yen longs from last week, and the dollar yen has recovered to 38% retracement. This has been a big this 152 level has been huge since October of 2022. You can actually just look at how many pivots we have around the 152 level. I mean, just point them out. I mean, if you guys, really want to see like right there, right over there. You got this one, you got this one, you got that one right there. Not the breakthrough, but the one right over there. Pivot here, and here we are again, and it's the 200 DMA. And I know you guys, we're talking about like the Ichimoku cloud too, which, if you're trading yen, probably makes sense that you pay attention to that we're right around the cloud top here, very close to. So, I'm not a big, I don't feel the desire right now to be shorting dollar yen, but I think we need to watch yields, because if yields start to come down, and by the way, yields have had a pretty decent move down, because if you look at the 10-year, the ZNs, we hit the 38% retracement at the end of last week. We've pulled back, yields have rallied, but you can see how we've bounced back pretty decently. But if yields start to struggle right around here, the dollar yen might start to struggle. So, if you're talking about playing ranges ahead of the Fed, or ahead of the Fed, sorry, ahead of the CPI, maybe dollar yen short up here is not a bad risk reward. But how do you feel about the yen right now, Kman?
Yeah, I mean, first of all, it's yields, but I found the snapbacks in cross yen are not pushing me to stand in front of it right now. Although I think technically and also psychologically, I can imagine we are going to find quite a few sellers up in 152, 2.25. Yields right now, yeah, waiting for CPI, man. I mean, we're around equilibrium level, I think, in what the tens are concerned. Slightly positive curve. That's not too bad either. If you look at dollar yen, because I mean, we used to have a correlation not only on the yields but also on the yield curve with the yen, and the curve being slightly positive is not really something that dollar yen bears would want to see. So yeah, I'm not standing in front just because of those crosses as well in the yen holding pretty well. Okay, I mean Aussie and Kiwi have their own issues, but you look at the rest. Sterling yen, even euro yen is crawling back up. Swiss yen is higher. Yeah, it's not a picture that I like to actually short too many yen pairs right now.
Yeah, I'm not super comfortable with it either, but I
Look at the level, you're there.
You take like, sterling yen, for example. I mean, we pushed outside. Now it's the sterling, which is obviously outperforming on the crosses, but we were breaking through this channel, and then all of a sudden, boop, we're right back into the channel. And, I look at things like that, and it does make me a little nervous. All right, well, hey, let's real quick go around the horn. Dale, what are you going to be trading today? What are you thinking about trading?
I'm still short euro and looking to sell the yen. I'm going to scale it from 52 to 53. So right in here, but 53, I think you have on the yen is halfway back. We're at 38 now. I'll just do a WD GAN, sell 50% retracement. That's up around 53. 8 down, 4 back up.
Got it. Well, we're right at that 200-day 50 DMA and 50% or 38% retracement.
Yeah.
If we choose through there, I can see us pushing it. Ryan, how about you? What are you looking to trade?
Me, I'm just monitoring what I've got at the moment, seeing if this euro sterling can break down a bit further. Maybe if we get a test of this low 82s, I may think about a separate long down there on a first test. Other than that, just managing what I've got, Aussie, Kiwi, and the rest.
Awesome. Well, that Aussie Kiwi, this is the one that, I know I let my short go like last week, and I should have shorted it last night. My intention was not there. So, but anyway, it's still, we break this 200 DMA, the 618 retracement. That thing's gonna be sayonara. Kman, you have any trades that you're looking at today?
No, I'm actually not looking at doing too much new, but I'm still a bit long cable because I kind of like sterling, but my biggest position is euro sterling short as well. I think euro sterling we have a good chance of seeing it lower until unless ECB really comes up with a hawkish surprise. But even then, I think we are going to find rally sellers in it. And nursing the risk, I don't like, although it's small, I don't like the Kiwi too much. My position, I'm still small long, but there's a risk that we are going to have a visit through 58 the figure and get some stops out of the way. That's the risk right now. That's about it, Blake. Not looking to
All
do
right.
much fresh right now.
All right. And you know, I'm maintaining my sterling longs from last week, and they're doing pretty well. I like the fact that the euro sterling is actually breaking lower. So you know, we start breaking back above 128. I think we start playing into this inverted head and shoulder pattern. Still has a lot of work to get there. Obviously, we got to get through CPI tomorrow, but I love the outperformance of sterling too. So anyway, Dale, you know, that's pretty much it. I just want to also mention, guys, if you haven't, you know, checked out Forex Analytix, make sure you do so. And this is our chat room. You want to see exactly what positions I'm trading, like just picking up some euro this morning. If you want to know what Ryan's trading, Kman, a lot of other traders in here, you know, showing what they're buying and selling. And you know, we're all obviously talking about all sorts of other things throughout the general chat room as well. You know, come join us in the Forex Analytics chat room. That's a place where that's like the most active community you're going to find in the market. So, Dale, it's all yours.
Okay,
We will
thank you,
see
Blake.
you a little bit later. All right.
All right, Blake. Thank you, buddy. Ryan, Kay.
Thanks, mate.
Yeah, happy birthday to your wife. Have a nice lunch, Ryan.
Thank
All
you.
right, all right. And that's the dream team, everybody. And now we have somebody who is also a dreamer. Daniel Hussey Jr. You're a dreamer, aren't you, buddy? Huh?
Sure, right? I mean,
You,
hopes and
uh,
dreams drive everything.
let me ask you this. You ever have trading dreams?
I do. They're often not the best, right? I'm being chased by market makers, and my stops are getting hunted, you know?
Yeah, all right.
The thing of nightmares.
You wake up sweating and everything. So, all right. So that's in your unconscious life. What are you
Yeah.
doing? What are you doing irrationally in the market?
Yeah. So let's see if I can't share a screen here. I mean, let's talk about some great let's see here. Oh, guess we
Stick
can
around
just
for Daniel. He might even talk about some soybeans here in the grains,
Yeah,
possibly grind.
you know what? But I wanted to start us off actually, maybe talking and just piggybacking on some of the conversations I just heard. I mean, really some great insights there on the macro economy. I couldn't help but notice the chatter right around rates and the yen. I mean, I think that's a great place to start this discussion and pick up kind of where, honestly, we had left off. I feel last time we were together here. Dale, this is a chart overlaying the yen futures, which are
Yeah,
basically the upside down dollar yen. It's just an inverted
right,
chart denominated in US dollars rather than in yen, which of course throws every Forex trader off because you've got to invert all your thinking. But the idea here is that there's been I mean, the long history of the 10-year note, which is your very colorful candle on this chart, and
right,
the blue, which is your yen futures are a very highly correlated asset class. And that stems from the long history of what is referred to as a carry trade. And many
right,
FX traders, we're all familiar with the concept. You borrow money in
right,
a place where interest rates are nearly zero, try to take it to a place where that cash to a place where interest rates are higher to earn what we refer to as a guaranteed yield. Of course, there's a little caveat in the middle called an exchange rate. You have to, put your dollars or your yen through to capitalize on that. But the idea is that because the yen and the Bank of Japan has trailed the U.S. interest rate and always been lower for the last 70 years or so since they've floated it, and since World War II, there has been a tight correlation in these asset classes. Now, what you see on a chart is, effectively, in my opinion, a bit of a bear flag or some consolidation after, the big decline in the U.S. Treasury market and this equates to interest rates rising since 2020 through today. And over the last year, we've been stuck in this consolidative range. Now, I'm not saying that there isn't a reason that we shouldn't break up or down out of this today. I just want to point out that the yen and the 10-year have diverged a little bit here since last July, with the yen being able to push to new extremes that the treasury market was unable to. And you can make a case that the treasury market bottomed there a little bit before the dollar yen tops. And now we've been in this battle over this very long-term trend. So pay attention to those relative highs and lows in this trend, because I do think rate decisions as of late and some of, Bank of Japan policy could change this, either, maybe continuing after a three-wave structure lower, perhaps. No one's really calling for interest rates to rise, but you can't ignore that to start the month off now. December here has kind of started to reverse the 3-month downtrend we've had in the Treasury notes, which is a signal for the market, in my opinion, that we should probably expect interest rates to still come under pressure. And that's why I think, headline inflation, like you guys pointed out, could be really key to some of that, to some of the Fed's choice and decision making here. I am cautious that they will kind of choose to punt any major decisions until the new administration's in office, because there's going to be a lot of changing of the guard, so to speak, between potentially the Federal Reserve and the Treasury Department as new appointments are continuing to come out. So we'll see. It's going to be it's interesting to note, though, that both of these markets seem to be heading back into the middle of the ranges that they've been in, going back to, October of last year, a whole year ago at this point.
Yeah. Does the Fed go a quarter, Daniel?
I think that's a safe bet. It looks like the market is starting to price that in and thinking about it. We certainly have seen a rally since the last decision. With consideration that they are going to be cutting probably here a quarter. I think a half a basis point is a little aggressive. Do I think they need to do that? Maybe, perhaps. But when you look at where the stock market is, where you look at where some other inflationary assets, cryptocurrencies are, in my opinion, the ultimate in terms of risk assets and inflationary signaling. They're at, arguably at all-time highs. So is the stock market. Those are only two things. When we look at commodities as inflation, there isn't much inflation out there, with the exception of maybe gold and silver of the last year or two. But that's another discussion we can table for a little bit here, because the S&P can't help but always remind people, and what we have here is a monthly chart of the S&P 500 going back to the 1930s, since the Great Depression, all the way through today. I mean, it doesn't get much more parabolic than this. It really doesn't. But I also think the notion that the stock market is a Ponzi scheme is a little misconstrued. It's certainly on the right course, but the difference is that there's obviously not just taking from Peter to pay Paul with the stock market. There's actually inflows. There are actually companies here that are paying dividends, some. And you do have a little bit more of a nuanced game going on. But I will agree that the stock market, in theory, is designed to always go up. And that's because it's designed to be inflationary. It's designed to take risk assets off the table and out of the cash market and put them to work in an asset class. Anytime you do that, simple supply and demand says you're going to drive up the price of the asset. And if the stock market is the all-encompassing place to take risk, well, you're going to have a one-sided trade from start of time until the end of time. And if the stock market crashes, it's very likely an indication that society as a whole probably has gone to the society that is trading it has gone to the wayside. Anyway, I wanted to point out, though, that the move we're seeing is not so different than what we've seen in the past. In fact, we only have to go back about 30 years to see a move exactly like this playing out. I've pointed out in the past, and this is a chart where I've literally made no changes to the drawings on it since the last time we spoke. And I try to do that because there are a couple patterns here that are really key to take away. The first is you can see the 200-month and the 200-month in purple here and 50-month moving average. Since 1945, we have had a bullish crossover event, a golden cross of these two. They have never crossed back over in their history since then. 2 attempts major ones that I want to point out that draw the major analog of this chart. The first is back in the 1970s, we had a massive flat correction in the market. We dropped from about 120 in the S&P down to 60, effectively a 50% retracement if you consider the market began at 0 and ran up to a 120 all-time high. The 50-month and 200-month moving average just a few years later, whoop, there we go, almost crossover after we get the first substantial bounce and the first big pullback, and they don't. We then proceed through all-time highs in the market over the next period. There's a period of inflation coming out of that into the 1980s, and we run up to a new all-time high around 340. We then have our Black Monday event. In October of 1988, or 87, excuse me, the market falls apart, drops nearly 20, 30%, and we effectively hold another 50% from highs to highs here, but it's a big pullback against the old recession low. We hold, the market starts to try a breakout of new all-time highs. It does so. And by 1995, we find ourselves in kind of a precarious situation where if we zoom out and consider what the market were to look like in 1995 when we kind of stop it there, it looks quite parabolic and almost like it can never continue. This is insanity, people say. We're at 525 in the S&P. How can it keep going higher? The wall of worry that the bull market climbs has begun. And we also had policy coming out of the 1980s that drove, well, other than incredible peacetime into the 90s and inflationary markets, we also had a stock market that just never stopped going up until 2000s hit. We have our dot-com bubble, we have a rebound in a flat correction, and a massive low during the 2008 Great Recession at 660. Now, we dropped in the S&P about 50% in that time, from 1600 down to 700 or 600. And it's not so different than that recession in flat we had in the 70s. The market then began a very similar pattern of rallying up. First major pullback, we almost get that 250-month moving average to cross over, but you can see here they never do. So it remains bullish. It is one of the few indicators of the life of the S&P since the Great Depression that is, in my opinion, the antithesis of recession versus depression. But nevertheless, the market continues on, pushes through all-time highs. And a few years later, about the same time frame that we had from our old recession low in the 1974 period to the 1987 low, what is that? 13 years later. About 13 years later, after the lows in 2009 and 2020, a little accelerated, but okay, 11 years, we get our millennial Black Monday event. COVID happens. Now, in March of 2020, we get the 30% correction in the marketplace from a 3,400 high, not so different than the 340 high, back down to a low of 220. Well, 3,400 down to 2,200 is the exact same move, just a multiple of 10 higher. And now we find ourselves breaking through all-time highs, having a little bit of a correction, and pushing through yet again. So I kind of urge everybody to see 2025 more like 1995 than 2020 or 2009, anytime the market's topped. So I like to kind of remind people, I should say, that the long-term trend of the stock market here is to go parabolic and to continue higher in these moves that are almost blinding in effect. So that doesn't mean you rush out and buy it here, right? And just get long and be bullish permanently. There's clearly some up and down the whole way, but remind yourself of where you are in the bigger picture. And if the same inflationary game and printing money and everything is the same, well, the stock market has the ability to do the same thing it did 30 years ago, just at a different scale. And that's something I'd like to, remind people of from time to time.
Okay, that was a very nice presentation to historically, say that
With context, right?
Yeah, you have to be crazy to have been a bear at all.
Right. But at the same time, I think we all know that bear markets happen. Those 30, 10%, 5% declines happen. And timing those is, of course, near impossible. But I think having in the back of your mind that since the end of the Great Depression and after World War II, these markets have been playing out a very cyclical game without any major shakeup to the global status quo. And I'm not saying that can't happen, right? But the game is still being played as it ever was, is I guess what I would say.
Okay, as it ever, the same as it ever was. Talking
Yes.
heads.
Yes.
Okay, all right. So the market same as it ever was. Anything developing that could be a transition, just like the red wave that we got in November.
Yeah, there's some new kids on the block. Cryptocurrencies offer a different asset class, right, that weren't around before. I think you need to think of those in some way as a developing, risk asset. Outside of that, I can't really speak to the future of what they will be. But some of our traditional assets like gold and silver, gold, for example, is behaving quite, I think, in line. I'm personally shocked silver has not rallied as much as gold, but nevertheless, it seems to be still entrenching itself in a bull market. We see some consolidation here, breakout of the last 2 days of gold above this downward sloping trend line, and very tight consolidated pattern we had. Seems to me to suggest that there may have been a head and shoulders pattern here that is actually not working out, and you could talk about an inverted one now, but arguably, I see gold and silver still potentially heading higher and continuing higher, especially alongside asset classes like cryptocurrencies. These are all alternatives to the dollar at some point. And I'm not saying you should be bearish the dollar either. I'm just saying that if we are in a period of inflation, asset classes are going to rally. And those asset classes that are denominated in US dollars, the trade of gold and crypto and oil, they can also benefit alongside the dollar going up in value as other currencies get sold to purchase dollars to purchase some of these commodities. And that's a concept that flies in the face sometimes of what we intrinsically think. But the breakout in gold of the last 2 days, I think, is also indicative of a potential rate, decline and the Fed announcement potentially, about a quarter basis point hit, and potentially, that ends up being more bullish for the stock market as well.
Okay. I was going to ask you about uh, what's happening in. I mean, you like gold, you like silver. Natural gas has an interesting COT setup. Normally, you have
Mhm.
don't you have the public is generally long, and the commercials are generally short, and it's the inverse right now.
It is. And the gap on Friday into this week was an interesting move. We have a chart up of January natural gas, a 4-hour chart. It's been very range bound. It's hard to be bearish natural gas when you start to get below 3 and down to 2. It starts to feel like, the long-term support on a natural gas, right? And there's value there. The problem is that in the production of natural gas, right? We almost never stop producing it because you can't, once you tap an oil well, it's very hard to turn off the natural gas that also comes alongside of it. So it seems to always have a abundant supply, which goes to your ideology that commercials are usually short this product because they have the physical commodity to deliver against short positions that they're ultimately looking to sell into the future. Speculators, like you pointed out, are usually long because natural gas over a long enough time frame. Let's get back to a sec here. Futures trader. Let's go back to just the continuous contract of natural gas to give everyone that idea. When you look at like a monthly chart, it seems to always come down, kind of like the VIX, actually. It always
Yeah.
seems to come down to some kind of floor, like it can't go below zero kind of thing, and then big spikes during periods of either shortages or high usage, or inflationary markets, wartime markets, whatever. The 2000 through 2004. Three run up was, was around that same, the invasion of the Ukraine and Putin and Russia tensions. We saw crude oil run up around the same time. But then high prices of commodities oftentimes lead to producers trying to produce more and flooding the market with as much as they can to take advantage of those prices. And eventually we come crashing back down. Over the last year, we haven't seen much of that seasonality we expect in natural gas, which is, high demand during winter months. And we're starting to see, highs in price happen during the summertime months alongside crude. So that's been a kind of a shakeup in the fundamental game for natural gas, but ultimately, month over month here, we seem to be building some kind of base again, arguably taking out multi-month highs. I think the next big level to take out to the upside is that 350 area. Otherwise,
Yeah.
don't get too surprised if we end up sitting in this, $2 to $4 range for a bit on the monthly chart. Day to day, though, right, we have been building higher. We had a bit of a gap there. November left us with a very, very wide trading range to be in or to remain in from 350 down to 250. So I think there's a big chance it could still be in that. But look, on that continuous chart, we are starting to go above the series of highs that have been holding us down for the entire year and
Right.
arguably flagging above them. I mean, that's a bull flag in the making, and it's just in its infancy, in my humble opinion.
Okay. 2025, what are you looking for? We're heading into it in a few weeks, new
Yeah,
year, new start.
lots of optimism, right? I think that optimism of the U.S. government system maybe getting back on track is certainly helping feed stock market and treasury trades. It's favorable. I think the U.S. does not look as poorly positioned as we did before in terms of an administration, in terms of international policy. But we also, unfortunately, have hiccups that we know the Trump administration in the past had thrown into some of the commodity trades, particularly with China. There have been tensions, growing over commodity trades with China for a decade. Um, but at least I think this time around, the Trump administration, his trade wars that we had the first time around, China and other trading partners know the table we're all coming to. And so there isn't going to be as many surprises as before. Now, having said that, one of the trades and a couple of the trades that we're looking at is soybeans. We have found this incredible bottoming process so far since last August. It is not that often that a contract low in something like soybeans at these prices is tested. I think I counted some 16 different tests effectively between 980 and 975. Somebody somewhere in the world finds immense value in soybeans at these prices. And without naming names, but China, who is the biggest buyer of soybeans globally, bar none, is, I believe, in here defending these levels based off of their own demand and needs. And we have seen this market basically defend the 980 figure in the January soybeans since August. The bottoming process here and this very choppy range off of lows is from an Elliott wave perspective, it doesn't look bullish. I will admit that. But it is at least a series of higher highs and higher lows in the most basic sense of it. And I am wondering if this isn't a very slow turning, rounding bottom forming in the soybeans. And I think it's very easy for the trader to watch. $10 in the soybeans, we get bullish above it. 980, we get bearish below. And anything in between is a little bit of chop. But when you take a big step back on this chart, above $10 can definitely open up to 1040, 1080, and maybe even runs up to those old summertime and prior the year's prior lows around 1040. Below
Wouldn't that
980.
wouldn't it be classic that the grains finally bottom after Cargill closes,
It
which has
would
been
be
around
classic.
forever? I
And
mean,
that's such a great capitulating moment for the commodity market. For those that don't know, Cargill is, I would say, bar none, has the most influence on all of our food prices and most of our commodities. There is almost nothing that family, it is a privately run company owned by, I forget the name of the family, but a family owns Cargill. they control just about the entire commodity flow, physical commodity flow, right? They're the ones mining Morton salt. They're the ones that are buying, running cattle operations, buying soy meal or soybeans, crushing it into meal and oil. They're the ones doing those things. Um, they recently had to lay off several thousand employees across the country after effectively taking it on the chin in what has been a big commodity recession in the last 2 years.
Right.
If your business model is tied to the production and sale of commodities at higher prices, when those come down, your business model suffers. And Cargill is going through a crunch on their own balance sheet, right? Due to that, we're seeing the layoffs occur, right? Which is a natural
Yeah.
management decision. And that could be a capitulating moment for
Yeah.
commodities in general, right? Like
It's like
that's
a Barron's
as
cover,
bearish as it gets. Exactly. It's a
It's like,
Bear Stearns moment
yeah,
for the commodity market.
yeah.
And
You like that, don't you?
I do. And we were chatting about that around the office too,
Oh,
because it
I
totally
had an
is, you know.
original thought, anyway. Okay.
Well, it is an original
Oh.
thought. I think it's extremely, I don't think many people are thinking about it that way because you look at a price of many of these commodities and you may not get that excited. But when you start to
Yeah.
take a deeper dive as to where they are in the bigger time frame, there's
Yeah,
definitely something
corn
going on.
looks good. Yeah, corn looks okay.
Corn looks okay here.
Great.
We're starting
Looks
to break
great.
some trend lines,
Yeah.
resistances. We're holding and basing. Corn's held up in a time above $4, which $4 is a very psychological level for the farmer. For those that are unaware, below four in this current environment, we start to turn non-profitable for many farms. So you can
Yeah.
say the same about 950 in soybeans, or 950
Yeah.
to $10. So we're also testing not only Cargill's threshold, a major commodity producer, we're also testing our actual mom and pop producers break even prices and holding them. And we usually don't go down there for too long because you're going to have a major issue in your entire commodity sector. But truthfully is once we get down to prices where you're no longer profitable, farmers are
Mhm.
very willing to let their grain sit in a silo because it won't go bad. They can wait till next year and for better prices. And usually on somewhat of a recommendation from guys like myself that are helping them develop that marketing plan. We have the means in the futures market, right, to buy puts, put a floor in the market here, make sure prices can't go below four for you in corn, but also plan for the move back to 450, 470 to actually do your sales. So what we're seeing here is a bottoming and rounding bottom, I think, in corn as well. We're starting to build that higher highs and higher lows day over day. This is a 4-hour chart. You can see the daily ranges
Yeah.
and the monthly ranges
Looking
on it, which is
looking good.
those things. And right now we're looking for corn to basically push up. And I'm going to flip my screen quickly here over to
Hold on quickly.
this one.
Everyone that's listening right now, look at your feet. Look at your feet. Take your socks off. Do you have any corns? Okay, if you don't, buy some.
Yeah,
All right,
and I
buy
think
some
this
corns.
quickly both the corn
Sorry, Daniel.
no, I love the humor. I wanted to point out two things that we watch for on commodities when they're turning in the particular. One is the 18-day moving average, which is this red line, is traditionally a pretty good short-term indicator of trend. You can see in a downtrend, it respects it as resistance on the way down. When it starts to fight with it, you start to get that divergence and a low forming. We also have the
Yeah.
55-day, which is green, 100-day, which is blue, and the 200-day, which is purple. That's
Yeah.
probably the next area we're going up to test, that 200-day. We
Yeah.
haven't tested it since May. And I wanted to point out this rising volume because we don't talk, I think, enough about volume in
You're
trading
right.
and what it can mean for traders. But as you start to break above some of these major technical levels and you see this increasing in buy side volume each day, that's a good
Yeah.
indication that the trend and market might be flipping. We're
Yeah.
seeing a similar pattern here in beans, but it's a little choppy. And last but not least here,
Wheat.
wheat. The March wheat contracts is doing that right now. I think that there's an opportunity here to watch the wheat break above this downward sloping trend line that we've been holding since October. We're starting to
One
get
more
above that
low,
18-day
Daniel.
moving average. Yeah,
I
one more
think
low is definitely
that'd be a
possible.
3 driver. That's kind of what I'm looking for.
A
One
hundred
more low
percent.
there.
And I think that right this low we had in August that was
Yeah.
taken out by I think one tick. I was looking for more of a
Oh, okay.
capitulation than that. But
Maybe that was it if they got all
it
the
could be
stops.
it, right? It
Yeah.
could be it.
Yeah.
But I don't know. Wheat has usually when wheat turns, it really turns, and it hasn't. It's not quite doing that yet. So
Yeah.
I'm on the fence, but I think I agree with you. Look for maybe one more move lower. But there are two other wheat contracts to consider here: the Minneapolis spring wheat and the KC hard red winter, which are also getting above their
Yeah.
18-day moving averages as well. So just to always point out in commodities you never should focus just on one chart. Go and look for that confirmation from those other correlated assets. If you're trading corn, look at what beans and wheat are doing at these levels too. If you're trading oil, crude oil, look at what soybean oil is doing. Look at what soybeans are doing. Look at what natural gas is doing at these levels. Those are ways of getting outside confirmation here. And what I see when I look across all three row crops, corn, wheat, and beans, is markets that have come down to test that August low,
Yeah.
unable to break it so far, and potentially starting to show the first signs of maybe reversing. And that's, and when you take a even a bigger step out to the monthly time frame, you start to see how far down we've come and realize that there might be value down here as well.
The grains in 2025, my friend.
Yes, I'm looking
Could be.
for a little bit of a rally here to start us off into the new year
Yeah.
and take us into the next. So those aren't aware, into the springtime when we're planting, and then all things can change. But
Well,
it's
we do
might
have
be the next seasonal cycle.
yeah, and we do have a different weather cycle in the ocean. It's La Nina now
Hmm.
rather than El Nino,
Right, and that
which
can
is,
change our
yeah,
weather patterns, and
yeah,
rain
drought.
makes grain, and the lack
Yeah,
of rain makes
yeah.
grain prices go up.
So Daniel, best place for people to reach out?
Yeah, you guys can always find me on Twitter here at Daniel Hussey Jr., dhussey at Zaner.com as well. But you find me on Twitter, you'll find all my info and be able to get in touch with me real easily.
Okay, so you can Daniel does full service work if you want to trade commodities.
That's
You can
right.
actually interact with Daniel and hear
That's
what you just heard for 30 minutes when you need to during market hours or
that's
even
right.
after.
And it's not just for commodity producers, although we do work right directly with them. Anyone who has exposure in futures or even financial futures, and you want to take a look and talk to somebody a little bit more, that's what we do.
Daniel, have a great holiday.
Thanks,
Merry
Dale.
Christmas, Happy New
Merry
Year,
Christmas to
and
you too, and Happy New Year.
we'll be talking in March, buddy.
Sounds good. We'll see you all then. Thanks for having me.
We'll see what the spring looks like in our brave new
Absolutely.
world.
Absolutely.
Daniel
Take
Hussey
care, Dale.
Jr., everybody. Thank you, Daniel, my trading warrior brother. Check him out. Daniel knows his stuff. You could tell. I could tell. Can you tell? And people are thanking you, Daniel. So that's a wrap, everybody. Have a good day. And don't just count your pips, count your blessings. See everyone tomorrow. You join the team in 13 minutes on the morning edge. If you don't have the ability to do it, take the trial for $1 and check out what they're doing in there this week. All right, everyone. Have a great day. Okay, I'll keep my head up, Tony, and my dukes up. Adios, Barry. Nice trading, Tony. See ya. Adios, Sinatra.